Picture a wildly popular restaurant in your city. I mean, a place with a line wrapped around the block every single night.
Right, the kind of place where the wait list is just months long.
Exactly. The reviews are glowing, the tables are packed, but behind the kitchen doors, there is a massive problem.
Hmm.
To keep up with that line, the owners are buying absolute premium, top-tier ingredients, but entirely on credit.
So we are talking like truffles and Wagyu beef flown in every morning.
Yeah. And because they haven't actually collected the cash from all those diners yet, they can't afford to pay their rent at the end of the month. The revenue is doubling, sure, but if that growth doesn't convert to cash in the bank, I mean, you have to ask yourself if the growth even matters.
And that restaurant dynamic perfectly captures the existential tension we are seeing right now with Supermicrocomputer. As of Saturday, August 8th, 2026, the stock closed at $31.13.
Which was up, what, nearly 6% for the day?
Yeah, up nearly 6%. But honestly, that daily blip just masks an absolutely vicious tug-of-war. I mean, the stock is down 47% from its October 2025 highs.
But somehow up 60% from its March lows, it's just wild.
It really is. Investors are staring at a staggering $60 billion order backlog and preliminary guidance promising massive margin expansion while simultaneously watching the company burn through cash at a terrifying velocity.
Well, welcome to Market Pulse Daily. Our mission here is to break down the price action, unpack the underlying catalysts, and really make sense of the market sentiment driving the biggest movers on the board.
Exactly. And before we pull apart the engine on this massive liquidity crisis, make sure you hit that subscribe button, leave a like and comment below with the exact stock you want us to cover on the next show.
And before we get into the numbers, we need to mention our sponsor for today's show, StockOracle. If you are trying to make sense of a polarized setup like the one we are covering today, StockOracle is an AI-aided stock research platform.
Right. It combines fundamental data, intrinsic value estimates, AI moat analysis, and deep portfolio tools. It really helps you pull together bull and bear insights, side-by-side comparisons, and advanced watch lists.
Just a very important reminder, though, StockOracle is a research platform. It is not financial advice. It is not a recommendation to buy or sell any security, and it is not a trading signal service or a provider of real-time market data.
Yeah, you have to remember that AI insights and valuation estimates can be incomplete or just entirely wrong, and market data may be delayed. Always verify important facts yourself before making any decisions.
We have a special 14-day trial link below in the description. That is an affiliate link, which means the channel may earn a commission if you use it at no extra cost to you.
Okay, so let's get into the surface-level financials, because on paper, this looks like an absolute dream scenario for any tech infrastructure company.
Oh, absolutely. We are looking at a trailing revenue growth rate of 56%. In their fiscal third quarter of 2026, revenue hit $10.2 billion.
$10.2 billion. That is more than double where they were sitting a year prior.
Right. But the market has largely digested that top-line growth. The obsession on Wall Street right now is all about their preliminary guidance for the fourth quarter.
Yeah, management is pointing to something that is almost unheard of in the hardware space. They are projecting their GAAP gross margins to jump to between 15 and 17%.
Which essentially means they are predicting their profitability will double. Historically, this company has operated on just razor-thin margins.
Right. The trailing 12-month gross margin has hovered around like 8.4%.
Selling bare server components is traditionally a high-volume, low-margin game.
Yeah, you are just competing on price to move boxes. To double that margin overnight requires a fundamental shift in what is actually leaving the warehouse.
Exactly. They are moving aggressively away from selling isolated components and shifting towards selling complete, ready-to-run AI systems.
Let's break down why that commands such a premium. We are talking about massive, fully integrated liquid-cooled server racks, because the newest generation of AI chips run incredibly hot, right?
Yeah, traditional air conditioning in a data center simply cannot prevent these chips from melting themselves down. Integrating liquid cooling, running actual plumbing and coolant loops directly to the processors within a fully assembled rack is highly specialized engineering.
So by delivering a rack that a data center can basically plug in and turn on, Supermicro is providing a premium finished product.
Exactly. And a finished product that solves a massive thermal bottleneck commands that 15 to 17% margin. Management also cited some relief in supply chain costs, like tariffs and shipping, which pads that number further.
The narrative sounds bulletproof until you pull up the cash flow statement.
Oh, right. The cash burn.
Yeah, all of that explosive growth, all of those fully assembled liquid-cooled racks require an astronomical amount of upfront capital. In their third quarter, operating cash flow hit a catastrophic negative $6.6 billion.
Wow, negative 6.6 billion in a single 3-month period.
It is wild. Just to frame how violent that shift is, in the preceding quarter, their operating cash outflow was a very manageable $24 million.
So going from burning 24 million to burning 6.6 billion completely decimated their balance sheet.
Entirely. Their quarter-end cash plummeted by 68.5%, leaving them with just $1.29 billion in the bank.
Which brings us right back to your restaurant analogy. The cash conversion cycle in the AI hardware space is currently brutalizing manufacturers.
Right. To build these premium racks, Supermicro is committing to approximately $39 billion worth of AI server components.
Yeah, they have to purchase incredibly expensive graphic processing units from companies like NVIDIA and AMD. Those suppliers demand payment.
So the company is fronting billions of dollars in cash to secure the chips, spending the time and labor to assemble the complex cooling systems, shipping them to the data centers, and then waiting up to 90 days for their customers to actually pay the invoice.
That lag between paying for the ingredients and collecting the check from the diner is what created a $6.6 billion hole.
And when you burn through your own cash reserves at that speed, I mean, you have to go knocking on doors to keep the lights on. They had to take on massive leverage.
Nearly doubling their bank debt and convertible notes, right?
Yeah, bringing their total debt load up to $8.77 billion. But debt wasn't enough to plug the gap. In June of 2026, they had to line up $7 billion in new equity and equity-linked financing.
We need to explain exactly what that equity financing means for the person holding the stock in their portfolio. When a company issues new equity to raise $7 billion, they are essentially creating and selling new shares of the business.
Right. It's like a pizza that is cut into 8 slices. If you own one slice, you own a significant percentage of that pizza.
But if the company suddenly cuts that same pizza into 16 slices to hand out to new investors, your single slice just got substantially smaller, even if the overall size of the pizza grew slightly.
Exactly. That is dilution. Retail investors are watching the company grow revenue at 56%, but their actual ownership stake is being diluted because management has to keep printing new shares just to fund the working capital requirements.
Elevated leverage from the bank debt combined with massive dilution pressure creates a very heavy ceiling on the stock price.
Oh, absolutely.
Yeah.
And when you have this staggering contrast, a $60 billion backlog and doubling margins on one side versus a multi-billion-dollar cash burn and dilution on the other, you get a completely fractured Wall Street.
Yeah, the analyst divide right now is a spectacle. The consensus price targets are scattered anywhere from $15 all the way up to $50.
A spread that wide for a company of this size indicates genuine fundamental disagreement among the smartest people in the room about whether this business model is actually sustainable.
Right. You have Barclays recently bumping their price target up to $38, and Rosenblatt is even more bullish, putting a target of $45 on the stock.
Their entire thesis rests on a time-to-market advantage. They are arguing that Supermicro can engineer, build, and ship these complex, liquid-cooled racks faster than legacy competitors.
Which means they will capture the lion's share of this immediate AI infrastructure boom.
But then you look across the street at JP Morgan, and they are aggressively waving red flags. They put out a warning highlighting deep risks, explicitly stating that the sales surge is completely overshadowed by the deteriorating cash position and governance concerns.
And when institutional analysts are this split, I always look at the internal metrics, like what are the people inside building doing with their own money?
Exactly. We see plenty of financial headlines calling this stock a bargain going into earnings because it has pulled back so far from its highs. But over the last 90 days, insiders have net sold nearly 690,000 shares.
And the ratio of those transactions is what really stands out. We are looking at 63 individual sell transactions compared to only 35 buys.
I mean, insider selling is not automatically a bearish signal. Executives have lives, they sell stock to pay taxes on their options, to buy real estate, or to diversify their net worth.
True, but you have to look at the pattern. This is broad distribution across the executive team, and it is happening while the stock is trading near its multi-week lows.
Right. Generally speaking, a cluster of selling at depressed price levels does not project absolute conviction. If the executive suite truly believed that the upcoming fourth quarter earnings were going to silence the critics and send the stock back to its October highs, they would likely hold off on liquidating hundreds of thousands of shares.
I'll push back slightly on the pure bearish interpretation of that simply because of the sheer volume of product they're launching right now.
Okay, let's hear.
On July 30th, they unveiled 10 new AI rack models. These are absolute behemoths capable of supporting over 5,500 pounds per rack, fully loaded with those premium liquid cooling options we discussed.
Oh, wow, that is massive.
It is. They also just announced a major partnership where AMD and SpectroCloud selected their systems for the AMD Instinct Coder inference solution. They are firmly entrenched in the trenches with the biggest players in the AI revolution.
So you have to ask, if these new product lines and the $60 billion backlog are guaranteed home runs, why are the insiders cashing out at a 2-to-1 ratio?
Answering that requires us to debate the core risk-reward scenario ahead of their impending earnings date. Let's lay out the bull case first, focusing on the sheer scale of the opportunity.
Yeah, the AI infrastructure build-out happening globally right now is historically unprecedented. Tech giants and sovereign nations are racing to build massive data centers.
Exactly. CEO Charles Liang stated the company has scaled manufacturing capacity to deliver up to 3,000 advanced racks per month. 2,000 of those can be outfitted with direct-to-chip liquid cooling.
Scaling to 3,000 racks a month is a staggering logistical feat. If they can execute on that volume, and if that 15 to 17% margin expansion is actually sustainable, the current valuation begins to look incredibly compelling.
Right, because the stock is currently sitting at roughly 16 times trailing earnings. Furthermore, it trades at a price-to-sales ratio of 0.6.
For context, a price-to-sales ratio under 1 means the market is valuing the entire company at less than the total revenue it generates in a single year. The market is pricing this like a traditional low-margin hardware vendor.
So if they confirm they have evolved into a high-margin, premium AI systems integrator, we could see a massive re-rating. The valuation multiple would expand, and the upside potential for the stock price is enormous.
That is the opportunity.
Yeah.
Now let's pivot to the bear case, because there are some very dark clouds hovering over their ability to execute this pivot without tripping over their own feet.
Yeah, the most glaring issue for institutional investors is a severe transparency deficit, especially when you contrast them with their direct competitors like Dell.
Right. Dell is fighting for the exact same enterprise AI server contracts. But every quarter, Dell openly discloses their AI backlog dollar figure to their investors.
They recently reported an exiting backlog somewhere between $43 and $51 billion. They provide a clear book-to-bill ratio, allowing investors to see exactly how many orders are coming in versus how many are being fulfilled. They show their math.
And Supermicro absolutely refuses to disclose their backlog balance on their official sheets. Management will happily talk about $60 billion in orders during interviews and preliminary releases, but they just won't put the firm, audited backlog number on the balance sheet for the public to scrutinize.
Think of it like a mirage in the desert. From a distance, that $60 billion pool of water looks massive. And for a company burning billions in cash, it looks life-saving.
But because management won't let analysts get close enough to examine the firm commitments, investors have no idea if that water is real or if it's going to evaporate before the company can drink it.
The mirage analogy holds up perfectly, particularly because management buried a very quiet admission in their own preliminary release.
Oh, right. They explicitly stated that the $60 billion in expected orders, quote, may not constitute firm commitments and may be subject to cancellation or delays.
Subject to cancellation. Those 3 words are terrifying when you realize the company just took on billions in debt to front the cash for $39 billion worth of GPU components.
They are walking a tightrope without a safety net. If a major hyperscaler decides to delay their data center build-out by 6 months, or if a competitor undercuts them on price and margins revert back to their historical single digits, that 16 times earnings valuation suddenly transforms from a bargain into a massive trap.
We also cannot discuss the bear case without addressing the severe governance overhang. This debate extends far beyond supply chains and liquid cooling efficiency.
Yeah, the company is currently operating under an ongoing independent board review regarding export control transactions.
Let's unpack the gravity of that. The United States government has strict export controls designed to prevent high-end artificial intelligence chips from falling into the hands of foreign adversaries, specifically China.
And the board is investigating allegations that the company's systems, loaded with restricted components, bypass these controls.
For a technology company relying on relationships with US-based chip designers like NVIDIA and AMD, an export control violation is not just a fine.
No. If the board uncovers systemic negligence or deliberate evasion, the regulatory penalties and the reputational damage could completely sever their supply chain.
Compounding the governance fears is the lingering trauma from their auditor situation. Back in October 2024, their previous auditor suddenly resigned.
And this wasn't a small regional accounting firm. It was Ernst & Young, one of the big four.
We really need to explain why an auditor resignation is treated like a financial earthquake on Wall Street. An auditor's entire job is to verify reality.
Right, they look at the company's books, their bank accounts, and their contracts, and they sign a document saying, yes, management is telling the truth.
So when a Big Four firm outright resigns, they're essentially saying, we can no longer sign our name to these numbers, and we refuse to be associated with this financial reporting.
It almost always stems from deep disputes over accounting practices or a complete loss of trust in management's representations.
Exactly why the market reacted so violently at the time. That resignation triggered a delayed annual filing and sent the stock collapsing from over $118 all the way down into the 20s.
And here we are in August 2026.
Oh.
And the scars from that Ernst & Young departure are still very fresh.
So when you synthesize a prior auditor resignation, an ongoing internal probe over illegal export transactions, and a management team that refuses to officially disclose a firm backlog while burning $6 billion in cash, well, the deep risks JP Morgan warned about become painfully obvious.
The path from explosive revenue growth to actual sustainable shareholder value is heavily obstructed. Management doesn't just have to prove they can build computers, they have to rebuild their credibility with the entire market.
And all of this analysis, all of this tension, it converges on one ultimate catalyst that is going to force the market's hand. That date is August 11th.
August 11th is the absolute crucible. This is when the company releases their full, scheduled fourth quarter earnings. We are moving past the preliminary hype and demanding the audited reality.
If you are tracking this stock, there are two specific metrics that will dictate the immediate direction of the share price. First, you have to watch the operating cash flow.
Right. We know the hole was negative $6.6 billion last quarter. On August 11th, management must prove the bleeding has stopped.
We need to see that operating cash flow turn positive or, at the very absolute minimum, become significantly less negative.
Because if they post another multi-billion-dollar cash burn, the market will rightfully panic about a severe liquidity crunch and the threat of even more shareholder dilution.
Cash flow is the priority. The second metric is the audited confirmation of those margins. The preliminary guidance promised 15 to 17%.
The audited numbers must reflect that reality. If the official results show that margins compressed, or if management gets on the conference call and admits that the margin spike was just a one-quarter anomaly driven by a lucky product mix, the entire bullish valuation thesis falls apart.
And the ultimate wildcard would be transparency. If management finally decides to disclose a firm audited backlog dollar figure, similar to how Dell reports, it would go a massive way toward closing the credibility deficit that has plagued them for 2 years.
Given their historical reluctance, a transparent backlog disclosure remains highly speculative. The market has already priced a significant amount of pessimism and fear into the current stock price, which means if management actually executes on the margins and proves cash flow stability, the upside re-rating could be violent.
But the structural risks, the massive capital requirements, the threat of canceled orders, and the heavy governance clouds, those are just as real.
It is the ultimate test of a company trying to scale at the absolute bleeding edge of the AI infrastructure boom.
In a market that is utterly obsessed with velocity, time to market, and top-line growth, we are about to find out if the cost of the fuel is finally going to outpace the prize money for winning the race.
Before we wrap up, a quick reminder to check out our sponsor, StockOracle. Use the special 14-day trial link down in the description to access their AI-aided stock research platform.
Yeah, you can dig into the fundamentals, valuation estimates, and AI moat analysis for the companies we cover. Again, it is a research tool, not a buy or sell recommendation.
AI insights and estimates may be incorrect, and market data can be delayed, so you must verify facts yourself. That trial link is an affiliate link, and the channel may earn a commission at no extra cost to you.
That wraps up today's analysis. If you want to stay ahead of the next major catalyst, make sure you are subscribed to Market Pulse Daily.
Leave a comment below with the exact ticker or company you want us to break down next, and we will see you on the next show.